Thanks so much for tuning in to Talking Point. I'm your host, Neeraj Shah. And the Talking Point today is the performance put up by KPIT Technologies. They take pride in saying that they are not an IT services company. Ravi Pandit went to great lengths to explain this to us last quarter. And this time around, at the end of quarter one, we've got Sachin Tikekar, again, needs no introduction really, to talk about what went behind the quarter one performance, which looks pretty solid. And what does this mean for the rest of the quarters? We'll try and talk about a bit about the internals as well. Sachin, great having you. Thanks for joining, and I hope all is safe.
Thank you very much. Thanks for having us. It's always a pleasure. Given what we have been through, I have to say that we are lucky and all is good. And yeah, absolutely. Let's get started.
Okay, so let's talk about the numbers. This while it was anticipated that you will do well, the performance 5% odd revenue growth quarter on quarter, and frankly, my EBITDA number has come a bit higher than what you guys have declared in the presentation. But that kind of EBITDA performance as well, what went behind it?
Actually, it's been a lot of work that we've been doing since the beginning of the pandemic. I have to say, since our new beginning, which was 2.5 years ago, which is to just focus on handful of clients, being the independent software integrator for them as the whole world changes from conventional world of automotive and commercial vehicles to the whole world of CASE, connected, autonomous, shared, and electric. And that's where all of our investments have been going. And as the pandemic was a glitch in between, but as soon as most of our clients started to get a handle on this, and they knew that they needed to make the transition, they started having conversations with us from the longer term perspective in terms of where they are and where they need to be, and sort of looking at us to be, being the bridge to help them transform from where they are to where they need to get to. And that has obviously led to a growth, not just this quarter, but in the previous quarter. And our hope is, if we continue to keep their best interests at heart and really help them make that journey, they'll look at us as a truly strategic partner. And we believe that in return, we'll have a long-term sustainable growth with these relationships.
No, please finish your point.
No. So that's what, at a broad level, that's what it is. And that's why you've seen after, the Q1 and Q2 of last year, where the industry went through a difficult period and it impacted KPIT too. But as soon as things started to pick up, all of our clients reprioritize the areas in which KPIT is an important player. And that is actually leading to this consistent growth that you're seeing, Neeraj.
Okay. Now I'll talk about the slightly longer term in a moment. Let me first focus on what went behind in quarter one. So you're saying quarter one was more of continuation of what people saw in quarter four, I presume. But you also expanded the margins quite considerably. Tell us a bit about that. And would you reckon that this showing can continue? Because you are right now currently close to the upper tier of the guided range, which at least I heard the last quarter. Would you believe this is sustainable? And what about the upticks that you might have to give? And could that impact margins in any quarter, depending on when you're going to give the hikes, if not already?
Absolutely. No, it's a great question. So, I'll cover the revenues first, and then we'll talk about the margins. In terms of the revenues, yes, there is a momentum that we built up in Q4, and that is helping Q1. And we continue to see a very solid conversations for long-term engagements as we speak with multiple of our clients, whether these are commercial vehicle makers or the passenger car makers. And that gives us the confidence that we should be able to continue the trajectory of growth for the rest of the year. Some programs they take a little bit longer to start, but they go on for a longer period of time, given that they are all production programs. And you saw some things actually going down. Powertrain is our largest practice, and it didn't go down, but it didn't grow as much. Correct, and that's because, just as an example, many vehicles actually went to production. Most of the vehicles were 2022 production lines, so they actually got launched. Hence, some of those programs got over. But now the new programs are getting started. So again, on powertrain, especially in the electric powertrain, we believe that now that US is taking it more seriously, and so is Japan, the growth will come back on the powertrain side as well. Speaking of margins, obviously growth contributed to the consistent growth contributed to the margins. Neeraj, we have actually focused on 4 things, right? In order to realize our vision, we are focusing on 4 mission things. And if you allow me, let me talk a little bit more about each of the missions. So, and how they are impacting the overall performance of the company. So first is building leading practices and platforms. This is very important for each of our leading practices, whether it's for autonomous driving or conventional or electric powertrain, whether it's for e-cockpit and some of our other services, including diagnostics. The focus has been, can we build what we call PTAs, the platforms, tools, and accelerators. These are the libraries that make us more attractive from the competition perspective. But secondly, they actually benefit the clients and us, because we are able to get them to the production program faster. So our focus is continued investments in these practices and building these PTAs that I talked about. And that leads to our ability to win more business. But secondly, it also helps improve our profitability because of the reusability that we bring in. So that's the first mission. And that is probably one area where we've been investing substantially over the last few years. Second part is about zero defect delivery. How do we give our clients an excellent experience when we actually get into programs? And that's something that we embarked on 3 years ago, and we embraced the culture of excellence. Just by reducing the red projects by 30%, the client satisfaction has gone up significantly, and actually it has made a noticeable difference to our bottom line. That's the second part. The third part is, how do we make KPIT the best place to grow for our employees? Where we really want people who are passionate about mobility to join our company, because we are really passionate about making a difference given our vision in mobility. And the role of our company as we see it is, how do we provide them incredible opportunities for their personal and professional growth? We are a technology company, so largely it's going to be in the technical domains. And we invest a lot in people, and we want them to remain on the cutting edge of the technology. In most practices, whether it's autonomous driving or electrification, we are the net talent creator. We can't just go out and hire people, especially in India. So we end up hiring a lot of talented people from colleges and through internships, and we make a lot of investments in them, and that also pays off. That's the third part of our mission. And last is just remaining focused on our T25, right? 89% of our business comes from our top 25 clients. These are OEMs, passenger cars and commercial vehicles, and some of them are our partners that are tier ones. So having that focus on these 25, and as I mentioned earlier on, keeping their best interests at heart, it also becomes easier for us to manage all of this operationally. So in our opinion, I think the culmination of all these 4 things lead to improvement in the margins, and that's something that we've been able to demonstrate over the last few quarters consistently.
So you reckon this is sustainable?
We believe so. We've currently, as you pointed out correctly, we are on the higher end of our guidance. And one thing, and we are still sticking to our guidance, even though the first quarter numbers actually came out on the higher end of the guidance. We are still sticking to our guidance of 16.5 to 17%. And I'll give you the reason for that. Last year was a very difficult year for our employees. They needed to, through very difficult period, they needed to uphold all our commitments to our clients. And what we have decided to do this year is to really reward them and also do increments that are in double digits and probably one of the highest in the industry. That will have an impact, and we are happy to do that for our employees. And that will have an impact next quarter a little bit. And after that, I think we'll sort of, with the continued growth, we should be able to be in the range or on the higher side of the range, of what we have said market. Yeah.
Okay. So quarter two might just bring about the averages out, as otherwise you could have been even better than the range. Just one question though, this upticks, as much as it is a reward for amazing work that your employees would have done, is it also the much needed antidote to contain attrition? Because that seems to be a problem across the spectrum.
Yes. And again, it's a great point, and it's something that has something that we expected to happen in Q1, and it happened. It's gone through the roof for the industry, different industries, not just our industry.
Yes.
And it's a red hot market. We believe that it will remain red hot for another quarter or two, just like we've seen it in cycles over the last 30 years. Things pick up and they remain red hot, but they don't remain red hot for too long. So one is that. Secondly, yes, we want to make sure that our employees are well compensated. But we always take a longer term view of things. We want our employees to join us, not just for the pay, because of the work that we do and the pride that we have in actually creating some kind of a difference. And most importantly, giving them an opportunity to be in the best place to grow. So a training environment that we create here, the kind of work that we do, and the impact that we are trying to make in the mobility world, these are also binding factors for our employees. We don't believe that just salary increments is the way to retain employees. Having said that, this year especially, we want to make sure that we reward them really, really well for doing an excellent job.
Okay. Fair call. So you sticking to the guided margin range. Just before I talk about the annual, actually, let me just get that question out of the way. Then I want to talk about the client wins, etc. this quarter as well. But if you've done 5% revenues growth, constant currency in Q1, which is on the back of a fairly strong quarter four, and we know that FY21 was a fairly dull year, not just for you, I'm just saying, but for you in particular, FY21 wasn't a great year per se. Why is it that you are sticking to the 15% number? It's not bad, 15% or mid-teens, whatever. I'm just quoting 15%. You said mid-teens. But why are you sticking to the mid-teens number? Because on the back of Q1, where you've done, and the fact that the base is so low, you could actually do much more than that. Are you being conservative?
And that's a very fair question. Looking at, you looked at the numbers and going by that, there is no doubt that, there is a potential for us to do much more. However, having said that, after what we've been through and what our clients have been through and some of the headwinds that they see, we believe that the longer term programs will continue and will be part of those longer term programs. And we are a lot more confident about that longer term sustainable growth at this point in time than having a very high spike in one particular year. And we would also like it to be that way, right? We'll rather grow in a very consistent manner, demonstrate high growth in a consistent manner over a period of time than have any kind of a spike. It may happen, as I said, but we are not planning for it at this point in time. All of our programs that we are winning are long-term. We really want to create value for our clients and not mess up just because there is an opportunity to do more. That's my honest answer to you. And as I said, we are sticking to our guidance for now. And in December, we'll revisit the guidance. to see whether we can go beyond what we have committed at this point in time.
Okay, just one question out of curiosity. Your net cash conversion has risen all through the last few, and
Yes.
you're sitting on a pile of cash right now. In Q3,
Yes.
the call, you had spoken about, you specifically had spoken about increasing the payout ratio as well. And
Yes.
of course, Ravi Pandit last quarter told me about possibilities of select tuck-in acquisitions too. So what's happening? I mean, what's the plan of utilization? Are you close to making some acquisitions, or are you looking to up the payout simply because of the kind of cash you're sitting on?
Oh, absolutely. No, a great question, and something that we've been thinking about since there has been a very substantial increase especially over the last 4 or 5 quarters. And I think the answer is we have a payout policy that we decide with the board. We look at what everybody else is doing and what we feel most comfortable with. So the payout will go up as per the policy incrementally. However, we still believe, given where we are at this point in time and the future that we see for ourselves, it's best that we keep the money and provide a higher long-term return to our shareholders than giving a lot more away. That's point number 1. And point number 2, you talked about inorganic growth. Now that it's been 2.5 years since our new beginning, we are coming out of the pandemic, and all of us are sort of clearer about the strategy and where we are going to be. We are looking at, we'll continue to look at possibilities of acquisition, and there are a couple of areas, as you can see. One is there are disruptions that are happening in cloud with 5G coming in. So if you look at our current business, when it comes to the software inside of the car, starting with the architecture, the middleware, and also the domains related to autonomous driving, electrification, and e-cockpit, we have deep expertise, and I think we are well respected in that region. But if you look at what's going to happen 2, 3, 4, 5 years from now, is going to be the connected vehicles and also the commerce. Most of the OEMs would want to monetize the data that they will have and their ability to do commerce through their vehicles. That we look at as an opportunity. So that is one area. Secondly, semiconductor companies are playing a more and more important role in the shift in the automotive. And we believe that working closely with them, we can create greater value. So that's the second area. And third is, even though we are very happy with the T25 clients that we have, there are 2 types of clients, correct? The conventional ones who have been dominating the automotive and the commercial vehicle industry for several years. But now there are the new disruptors that are coming, and they're changing the game. Unlike your IC engine being the differentiator, or your chassis or body and everything else, now the differentiators are led by software. And then there are companies like Google and Apple and even Tesla that are essentially software companies that are building a car around it. So we understand that these companies will become important players in mobility in future. It'll be good to have access to some of them. So that could also be an area where, if we find a company that is deeply engaged and that can create value, that could be one option where we may look at inorganic growth. So these are the 3 areas.
Are you close to any of these areas? Are you close to an acquisition?
There are good conversations that are going on right now. Hard to commit at this point in time, Girish, to be honest with you.
No, fair.
But there are healthy conversations that are going on at this point in time.
No, I don't expect you to tell me more, but I just wanted to get a basic idea. Just one quick question, Sachin, on the deal wins as well. You've got what's happened in Q1. What's the nature of the wins that have happened? Because you are on record saying that your clients are seeking deeper engagements. 85% of your business is repeat business. So tell us about the new things that have happened in Q1.
Yeah. New things that have happened in quarter one is most of the wins have been from our, or as we call them, long-term engagements. They've been with our T25 clients, just new programs, and OEM in Europe, where they're ready to go from level 3 to level 4 in autonomous driving. There are multiple programs, long-term programs that we have started working on. In the diagnostics area, the new generation diagnostics area for another OEM in Europe, we have started a long-term program. Then there is a Japanese OEM with whom we have started working on infotainment leading to digital cockpit. So again, that's a 5 to 7 year kind of a journey. Very interestingly, Neeraj, the kind of engagement that we are working on, we are taking it to another level. There is this whole shift in the software architecture. The cars that are built by the new players versus the cars that were built by the conventional player, the software architecture is very, very different. It comes naturally for the newcomers, the Teslas of the world, to build the software in that fashion, and they are in the lead. And the others are playing a catch-up game. So we are actually engaging with 5 of our existing OEMs to see how we can help them change the software architecture over the next 2 or 3 years so that they're fully back in the game. Those are the kind of engagements that we are excited about. And some of these will get started in Q2 and Q3. But like I said, the nature of all of these engagements is 3 to 4 years or 5 years in some cases.
Just a quick follow-up on that, Sachin, before we wrap up.
Absolutely.
I know you guys never give out the sizes of the deals, and I don't want that, but I'm just trying to understand. If you're talking to 4 or 5 presumably large OEMs in the world for changing the whole architecture, software architecture, and with the presumption that you are playing a pivotal role in that, I'm assuming that these projects are large, not just in terms of the tenor, but also in terms of the sizes. Is it safe to assume that if they materialize, they could be multiple times an average contract or some of the higher contract wins that you would have had?
They would be on the larger size, on the larger spectrum, for sure, Neeraj, to your point. They will be over a period of time. Having said that, I have to say that when we work on these kinds of complex programs, it's not KPIT will play the role of software development, software architecture, verification, validation. We have to bring in many players from the ecosystem to make it all work. The hardware platforms and the cloud players and so forth. So the deal size for the spend will be tremendous. And KPIT will also get a fair share. So I just want to make sure that you understand that there will be multiple players doing their own bit in trying to make this all work. But from the software perspective, yes, it would mean fairly large long-term engagements for KPIT.
Well, great talking to you this quarter, Sachin. And I wish you all the best for the quarters ahead. It will be lovely to take a status check at the end of quarter 2 as we hopefully open up and things start improving.
Oh, no. Thank you for having me. And thanks for taking the time to, get through some of the details. I really appreciate it. And look forward to speaking to you in another 3 months or so.
Likewise, Sachin.
Hopefully, we'll have a lot more to share with you at that point.
Oh, yes, indeed. Thank you. And viewers, thanks for tuning into this edition of The Talking Point.